Hi everyone, my name is Piterpakulski. Today we'll continue building a financial model of a clothing store or a shoe store. So we are building actually a chain of 40 stores. And today we will be answering a very important question: how much financing we need for our business idea. So we already built the cash flow statement. And the first question we are asking is how much money we need in this case or that case. And today we will be answering this very simple question. So please guys, like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links in the description of this video as well. So you will be able to watch all tutorials absolutely free from scratch till the final overview. So let's first of all quickly run through what we did before during our previous tutorials. So in our model we have six types of stores. So for example, small, medium, big store. For example, store that performs not very good, so this generates losses, for example. And we have in the core we have a chain of 40 stores. We can specify what type of store we're gonna open, when we're gonna open this store. We can switch it on and off from calculations. So, and here we have some kind of portraits of these stores. So we have 6 portraits, and these portraits we can choose between these portraits in our chain of 40 stores. So let's first of all dive into one portrait, and I will show you how it works. So first of all, we have a rule that all inputs in our model is colored with blue, like this, like this, like this. So these are the inputs. We're not touching other cells while scenario modeling. So we are playing only with blue cells. Other cells are formulas. So first of all, in our store we have 2 collections, for example, spring summer collection and autumn winter collection. Here we specify when we start selling the first this collection. Then we are setting up the product line here. These are the prices. We can switch on and off different products from calculations. And we have global and local coefficients for pricing for scenario play. Then we specify the sales plan. We have global and local coefficients for scenario play for sales plan. Then we are setting up the level of manufacturing costs as a percentage of the price of this price. We have global and local coefficients for manufacturing costs. Then we are setting up the discounts for the pricing. So when the collection gets inside the store, we have no discounts, then some discounts are, then discounts start growing. And then we have sales, for example. So here we specify the level of discounts for our product line inside the timeline. Then we start working with the sales plan. So we are allocating the percentages of sales plan inside the timeline. So for example, when the collection appears in the store, on the first month we're selling 40% of units, 40% of sales plan. Then on the next month 20%, 10%. So we're allocating 100% of sales plan inside this timeline for different types of products. Then we have the same story for autumn winter collection. So product line, pricing, sales plan, discounting, Then for each collection, so we start selling collection in March, for example, spring summer collection, and before March we have 6 month period where we will be allocating the manufacturing costs. So these are the manufacturing costs, and we are allocating the percentages of manufacturing, the 100% of manufacturing costs inside 6 month period before this collection gets inside the store. So this is the story for spring summer collection, and this is the story for autumn winter collection. Then we are specifying fixed costs for this store, amount monthly. Then we can switch it on and off. We can play with global and local coefficients for these costs. Then we have payroll. These are the positions, amount of people on each position, salary per person on each position, on and off, global and local coefficients. Then we are moving to the investment plan. So here we are specifying what we are investing in. This is the moment when the store starts its operating activity. And here is 6 months prior to this moment. Inside this 6 month period, we are allocating how much we are investing in and what we are investing in. We have global and local coefficients here. We have on and off buttons for specific items that we are investing in. So all that will be necessary during scenario modeling. Then we can also specify the life cycle for the store. So for example, if we assume that some stores will generate losses, we will have to close them after some period of time. And here we can specify, for example, we can create a store that will generate losses, for example, and we will be closing this store after, for example, 24 months of operating activity. And here we can specify this period of time after which we will be closing this store. So this is the asset tax value. Then we are assuming that this store won't reach the target revenues right from the first month of operating activity. So it will be reaching the target revenues step by step. So this is the first month of operating activities, second, third, fourth, and these are the percentages of target revenues that this store will be reaching. So we can play with these percentages, and playing with these percentages will allow us to see if we have some operating losses that we'll have to add to the total amount of financing for our business idea. So this is a very important block of inputs. The same story happens with portrait number 2, 3, 4, 5, and 6. Then we are moving to the core. So here we are setting up the first year of our financial horizon. Then we have global coefficients for pricing, sales plan, manufacturing costs, fixed costs, payroll, investment plan, so we can increase and decrease prices. From here, for all the portraits, we can name our 6 types of stores, 1, 2, 3, 4, 5, 6. We can switch them on and off from calculations from here. And then we have a core of 40 stores. And for each of 40 stores, we can select different types of stores, the portraits. Then when we're going to open this store, we can switch it on and off. And this information will go to this will affect the cash flow statement. This will affect everything. Simple, discounted payback period in future, and so on. Then we are calculating the revenues for the chain, manufacturing costs for the chain. Then we are consolidating the data. Then we're adding the loan to our project. So here we can specify the amount of loan, term of loan, interest rate, grace period for interest payments, grace period for principal payments, when we get this loan, year and month. Then we start talking about management company. So we have four variants of when management company will appear. So first variant is when we're gonna open the first store in our chain. So this is the first. So the management company will be linked to the first store of a chain. Then the second variant, so the management company will be linked to the specific amount of stores when we reach the specific amount of stores in chain. So for example, in this case, the management company will be linked to the moment when the chain reaches 15 stores in it. And the third variant is a management company so we're setting up manually when we specifically want to open the management company, year and month. So here we specify what variant we would like to choose for our calculations. We can switch on and off the management company to see the performance of our chain itself or with management company together. Then we have fixed costs for the management company, payroll for the management company, investment plan for the management company, asset tax for the management company. Then we are setting up the rates for the taxes. Then we are building cash flow statement. And now we can move to the financing. So how much money we need to start our project. So what is the rule? So the basic story is that in the cash flow statement, the cash balance at the end of the period must always be 0 or positive. So if it is negative, like here, this means that we need to finance these losses. So this is called cash gap. So this period is a cash gap. So we need to avoid all these reds, and we have two pockets to compensate these losses. Equity, so this is the money from our pocket, and the loan, so it is a bank story. So first of all, we can use, for example, our own pocket. So we will be just looking at this line and we will be putting this value with an opposite sign here. So for example, so we see how these values disappear. Then for example 52, then for example 54. So we can, for example, look further and say we're going to invest $2 million. So we put $2 million in a project, and then we start eating this money. And here we can see when this money are eaten. So the project ate all this money. For example, now we're going to put here, for example, $14 million. So they will be eaten somewhere here. Then, for example, we're gonna put 24 million. Oh, so here will be 47. Let's put 47. And here we need additional 587,804. So here we have 0. Let's go further. We have a small losses here. Let's go to the right, and here we can see that red in balance at the end of the period anymore. So now we can just go and create a total for this line, And now we need now we know that we need 68 million dollars, for example, to start this business in this particular case, in this scenario. Now, for example, we can what we can do, we can add a loan here. For example, let's go up. For example, let's add a $20 million loan. So we'll take it, the term will be 72 months, this will be the interest rate. For example, this will be, we will take it on January 23. For example, let's go back to the cash flow statement. So here we can see this loan. We see that we don't have cash gaps here. We're moving to the right. And here we can see cash gap again. So now we're using, for example, our own pocket. For example, we can see 45 millions here. So let's add 45 millions here. So we need additional 17,541. Now let's go further. We need so we don't have cash gaps further. Now we can create so we can see that we need this amount from our pocket, $20 million we need from the bank. So let's create a very simple table. So this will be financing needed. So this will be type of financing. This will be equity. This will be loan. And this will be total financing needed. So these formulas I will be pulling from the end of the cash flow. So now I know how much financing I need in this particular scenario. But what is the problem of this story? The problem is that I was putting these values manually. So when we are creating when we are testing our project, we are creating a huge amount of scenarios. So 10, 20, 30, 40 is okay. And for that purpose, we need to automate the process of calculating the amount of financing we need in this case, that case. And for that case, I will copy this table. I will create a table, name it financing, and what I will do, I will take this value, the result from operating activity plus the result from investment activity plus loan minus principal payments minus interest payments. Now I will make this formula cumulative, and now I'll extrapolate this formula. Now I will write a very simple formula. I will just find the minimal value in this line. Now I will just make zeros here, zeros here, and now I will put here equals, for example, then add minus and pull this cell, and now magic has happened. So we can see that if we look at cash balance at the end of the period, so this is mathematical zero, and since this moment the project starts generating its own cash. So now I can build any scenario, and this table will automatically give me the amount of financing needed, with the rule that cash balance at the end of the period will always be zero or positive. So for example, I just wanna increase the amount of loan, for example. Let's say that will be $50 million loan. So now we can see how the project, the formula recalculated the result. So this is the zero. Since this moment the project starts generating its own cash. Or for example, I just want to see how the business will perform if I won't take any loan, for example. So let's press 0 here. Let's go back. We can see 0 here. Now we're looking at cash balance at the end of the period. This is 0. So now, for example, we can see, for example, if I want to increase, for example, the pricing, let's assume, just for example. So I will be able to see, so these numbers are changing. So now we can play, for example, if we want to switch off some stores from calculations, for example, we can go here and see how much financing we need in that case. So now we can see that this table allows us to see very quickly how much financing we will need in this case, that case, because when the financial model is ready, when the one formulas are ready, so the entrepreneur usually starts creating a huge amount of scenarios and starts testing what parameters of inputs seriously affect the financials, what are the strengths, what are the weaknesses, and this helps future business owner to understand his business idea very quickly and find the best scenario of setting up his business idea. So I hope you enjoyed, guys. Please like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video, I will give you the link to the playlist where I will be keeping all these tutorials. And when I completely finish this model, I will give you all the links in the description of this video as well. So you will be able to see the whole process, how I created this model from scratch till the final overview. So thank you guys for watching. See you next videos. Thank you and bye.